Good morning, good afternoon, good evening, folks. Michael Zuber, one rental at a time. Wow, our first two episodes. First, we learned the SEC is illegal, apparently, according to the Fifth Circuit. We learned all about that. Then we talked about desperate syndicators and some crazy things I'm seeing. Video number 3 with Jonathan is I'm going to throw him some of my thoughts and opinions about 2022 and 2023, and I'm going to just let him react. How you doing, buddy?
I'm doing great. So I'm looking forward to this. This is like the speed round.
The speed round. So I think we're going to go right to the Fed funds rate.
Okay.
I think the Fed keeps raising rates until the Fed fund rates next summer is at 4%. They're not going to pause. They're going to let the stock market fall 30, 40, 50%. They can't relent. They got to beat inflation, and they won't stop until the Fed fund rate is at 4%. What do you think?
Yeah, I don't disagree with this. I think that, maybe they won't go quite as far, but I think they're going to continue raising because I think people are screaming about inflation and they don't, and that's kind of when you talk about what their mandates are, it's price stability, right? And
full employment.
And most likely when they did the taper tantrum before, they didn't see any threat to price stability.
Inflation was sub 2%. I went back and looked.
They figured like, yeah, it's okay. We can lower rates again.
That's exactly right. The only reason they gave up on the taper tantrum wasn't because Wall Street was there and they're trying to bail out their buddies. It's because prices were stable, sub 2%, and unemployment was roughly 6%. They said, okay, fine. We've got the other two covered. We'll do this.
Yeah.
That is not today. So a lot of people would buy the dip. I have a lot of people on my channel, like 30% of my commenters think I'm nuts. They all think the Fed's going to stop raising rates by like June. I'm like, are you kidding me?
Yeah, no, because listen, so the other thing too is that we're back to like record low unemployment.
Exactly. 3.6, 1942 was the last time we were this low.
Yeah. So we literally have inflation plus a really robust jobs market. And the Fed is now making pretty much the opposite calculation that it made in the taper tantrum, which is that the economy can sustain higher interest rates and we must raise rates because of where inflation is. We have to get price stability again. So and they think that it won't cause a recession because the economy can absorb it. Yep. And so that remains to be seen. But I agree with you. I'm not sure. I don't know. Do they get to 4? I don't know. But do they keep on raising?
My opinion.
Yeah. Do they keep on raising? Yes. I believe they keep on raising until they feel that they've gotten inflation down to an acceptable level.
Yeah.
Right. So, and Wall Street may yell and scream, but
Wall Street be damned.
Yeah, because at this point, their legal mandate. Although, listen, I guess the Fed is a constitutional creation, so the Fifth Circuit can't get rid of the Fed.
Not yet.
Not yet. But
okay.
But I think they will. They'll continue raising it.
So here's another one. This is mainly for apartments. Again, I own apartments and homes. I think apartment rent growth, when you look at over the next 5 to 10 years, let's just say 10 years, will be below trend. And again, I see trend again nationally quoted at 3%. I think we will be far closer to 1% when we zoom out until 2029. I think rent growth is going to disappoint given we've had so much the last 2 years.
That is very interesting. I think that well, listen, population growth is declining in the U.S. It's been declining for some time, right? So the imbalance that we currently have between supply and demand is going to start catching up, right? Because there also is a lot of building going on right now.
Exactly.
Right. There's a lot of construction, and at the same time, we are starting to see the population sort of leveling off, right? So whether it's 1%, really, I'm going to disagree with you here.
Cool. That's great.
Because part of the reason why you underwrite the 3% is because that's always been essentially the inflation rate, right? So I don't see. I think we're still going to have. Maybe we'll have a recession, but that's not going. We're not going to have it's not going to last for years, right? It's going to last 18 months, 24 months, and we'll go back to rent growth. So I think that will probably still be more in the historical sort of 2 to 3% range, just because of regular inflation. And
Mhm.
and if there's higher inflation, then it'll be higher.
Okay. I like it. I love talking to experts because disagreement is good because I have a bias sometimes and I like to see the other side. Vacancies. A lot of people got addicted to record low vacancies. Again, I think over the next 3 to 5 years, we will see vacancies and bad debt collections go up significantly. And again, I think it will be above trend. I think most people write to 95, 96% occupancy. I think it's going to get worse. I think we've seen the records and now we got to go to the other side.
Well, I mean, these two things are connected, right? The rent growth and vacancy levels,
Mhm.
right? So, and I think I think vacancies are going to be really, I mean, the rents too, but vacancies are going to be really sort of market specific.
Mhm.
And it
Sure.
really depends on the amount of building and, whether the building is keeping up or exceeding population growth. And
Mhm.
there are so many factors that go in, or I shouldn't say population growth, just say demand for apartments, because this
Yep.
is affected by all kinds of factors, right? If there's a recession, demand
Mhm.
is going to lessen, right?
Yep.
If people's wages go down, that's going to lessen demand. Like there's all sorts of things that go into this calculation, and how much gets built, whatever. I think that vacancies. I mean, I was actually just interestingly enough looking. I was underwriting a deal before
Mhm.
we got
Yeah.
on the call, and this is it's a property that's about 60, 70 miles north of New York City. It's
Oh,
an area that it's just very stable. It has like very, very slow population growth, and it has for a very long time. There's no big cities there. There are some like decent sized towns and sort of 50,000,
mm,
but the population of the county itself is like 600,000 people, but there's no
got
like
it.
big,
Yeah.
huge population center.
Mhm.
Um, and so I was very interested. It has stats like when the the peak rent growth and peak rent declines and stuff like that. And of course, around the Great Recession, you had some rent declines,
Mhm.
but it was only like 3% decline, which was really surprising to me.
Yeah.
And in the and in terms of vacancy, like you didn't really see that much vacancy. And the
Mm.
reason for that is because it's very hard to build,
Yeah.
right? And so in markets where it's really hard to build, I think that you will, unless you have like accelerating population decline, right, you will maintain high occupancy just because the supply of
Yeah.
is there's not enough, right? I think the danger. Now it's funny. Part of one of the casualties of this long, long expansion that we've had is uh, a lot of sort of like industry institutional knowledge has disappeared.
Mhm.
So one of the
Yeah.
things you talk about, so some of the like Atlanta is one of the hottest markets in the world, and Phoenix, one of the hottest markets out there, right? And the population growth is like really strong,
Mhm.
right? But it has been. Population growth is to Phoenix and to Atlanta is not significantly stronger now than it has been for several decades, right? It's
Mhm.
just become really noticeable now because it's been going on for such a long time, and like the populations of those areas have really
Mhm.
swelled. But it's not like this is a
Well,
new
well,
phenomenon.
I actually think it. I think there's actually a connection. I think the impressive, Atlanta, Florida, Phoenix, Vegas, it's equally impressive because of who's losing. I think that's because California's had negative population for 2 years. That is new.
Well, yeah, it's true. I mean, but it's always been coming from the same places too, though, right? And there's
Mhm.
also it's also, I mean, another thing too that people don't really notice is where, to the extent that there is immigration, like where are those people going? It used to be that those people were going basically to New York, Los Angeles, whatever. Now
Correct.
they're going to
Now,
Atlanta or Phoenix or
exactly.
Texas or whatever. So that's also boosting the population growth. But the point I wanted to make though is that there has been strong population growth in those places for
Sure.
decades, right? Ever
True.
since World War II, right?
Correct.
Essentially,
Correct.
once air conditioning became a thing, people
Yeah.
started moving south, right?
Exactly. It's easier
And
to live inside. Yeah.
yeah, right. I mean,
Yeah.
before that, like nobody wanted to live there.
Yeah. It was unbearable. Yeah.
Yeah. So uh, air conditioning really changed the game. Uh, but anyway, the point I wanted to make is that it used to be like really common knowledge that like Atlanta and Phoenix and a couple of other places were just famous boom and bust markets. They were always overbuilt in the upcycle. And then they had nasty crashes. And like Atlanta in the Great Recession had one of the worst crashes in multifamily. I'm not talking about,
Yeah.
I mean, it also had a terrible crash in single family, but it sucked wind,
Yeah.
right? And really badly, right? And Phoenix did too. But all that's sort of been like forgotten about. Now, maybe the population growth is now so, I mean, I think this is what people are banking on, that like the population growth has been so strong that construction can't keep up. But I'm sure that was the argument every other time in the past too.
Of course it was. Right? Yes.
So what I think you're going to see is that certain markets get overbuilt, and those markets will have higher vacancies.
It happens every time.
You know, it's just the real estate cycle. That's what happens.
Builders build until exactly.
Yeah, they build until they can't build anymore. They build until the banks stop giving them money.
Exactly.
Right? And then, but a recession will cause them to stop giving them money, right? And then that'll, building will stop, and the population increase will absorb those apartments over time, and then the banks will start lending again when absorption, when vacancy levels fall to a certain level. What you'll see, I think in places like, New York, is that it's just so freaking hard to build.
Yeah.
Like New York City, you keep on talking about New York City is like losing population or whatever. I mean, the vacancy rate in New York City has not exceeded 3%. Since World War II, except for like last year once, right? But the market is so tight here.
Yeah, you're already back to record levels. I look at New York. My daughter lives out there all the time, so
and it's like, and so even these markets up in where I'm looking in upstate New York, the long-term vacancy rate, it's like 1.5%.
Yeah, it's crazy.
Like, so
here's the last stat I'll give you as we wrap up episode 3. I think unemployment at least doubles by the end of next year. So we'll go from 3.6 to at least 7.2.
That is a pretty out there. You're putting a stake in the ground, Michael.
Yeah, by the end of next year. So 18 months.
Well, that's going to involve obviously then you're calling for a pretty severe recession.
I am. I'm calling for stagflation this year, which more and more people are agreeing with. And I call a recession either Q2 or Q3 or Q3, Q4 of next year. Yes.
Interesting. Yeah, I don't know. I find that one a little hard to believe, but we'll see what happens.
There you go.
Hopefully I'm right and you're wrong. But
I don't know. I'm not sure what I want. I like to buy some more real estate cheaply.
Well, yeah, this is true. Want some targets, right? But
exactly. Well, Jonathan, this is always fun, folks. He has a playlist on this channel with hundreds and hundreds of hours talking about all things multifamily. It's been a joy to speak with him every week. Where can people find you?
Yeah, so if you would like to join my investor list, please Google Two Bridges Asset Management LLC and fill out the form, and I'll add you to the list. If you would like to get coaching from me about how to do real estate investments yourself, whether you want to do syndications or you just want to learn how to do it right, like buy deals correctly, underwrite deals correctly, it's a very, very affordable program. You can go to multifamilylaunchpad.org/join. And then the last thing is, if you would just like to be part of the conversation in my Facebook group, which has got about 12,000 folks in it, you can go to Multifamily Investment Community on Facebook.
Awesome. Thanks, Jonathan. Thank you for your time.
Absolutely.